Hello, everybody. My name is Fran Green. I'm the Northern National Sales Manager here at More to Life. And we are here with our Learning Lab Live events, what is now week 4. And the Learning Lab Live events themselves, if you've missed them so far, have covered a variety of topics, including market updates, market challenges and opportunities. We've looked at our tailored enhanced plans, which are plans that are there to give better customer outcomes for those who might have life-limiting conditions or lifestyles. Last week, we looked at this topic of affordability, which will bring us nicely into this week's topic, which is payment term, lifetime mortgage, our mortgage product that is a true hybrid that we'll be discussing in much more detail in a second. Now, there are future events for Learning Lab Live to come up as well, which will include things like lead generation, marketing, other product innovations, hopefully, as well as the tools that More to Life have available to you to support you in your developing business, as well as your day-to-day work within the lifetime mortgage market. Now, all of these are available to register. There will be links available. So please do look out in your inbox for further invitations to these events, which enable you to rack up those CPD points, minutes and hours during what is generally known as a quieter time. They are also will be available at the end of each week on demand. So you can go back and recover over some of the ones that you may have missed if you wish so. But in the meantime, getting on to this week's event, then I will just share my screen and start talking to you about what is our new product, our Flexi payment term lifetime mortgage. Now, Flexi payment term lifetime mortgage is, as I say, a true hybrid in so much it is a lifetime mortgage with a rate that is fixed for life and a term that will continue in perpetuity until the borrowers have either passed away or moved into long-term care. But additionally, it does have a term element to it that covers a contractual mortgage payment requirement. Now, we'll go into the details of the eligibility and what that looks like in a second. But it is, as I say, a true hybrid that has that rate fixed for life and is part term and part lifetime mortgage. Now, this product is intended to help, broadly speaking, 4 different categories of borrower, although I have snuck in a 5th in the middle more recently, which I will touch upon as well. So the first is somebody who is simply needing a higher release at a younger age. And because they have an ability and a willingness to make that contractual mortgage payment for that contractual payment term, they can do so with a PTLM, as we affectionately call it. Now, the second customer persona is somebody that actually can receive those higher releases in the market currently, but probably be looking at a rate of 8 point something in the high 8s to be able to achieve their borrowing objectives. Again, with a willingness and an ability to make a mortgage payment, they can do so with PTLM at much, much lower rates for the benefit of their estate overall. Now then, this brings me to the third customer persona and also one of the special features of our PTLM. So unlike other RIO and TIO or hybrids in the market currently where you're required to service all of the interest, with PTLM, you're only required to service part of the interest. And as such, our monthly payment is simply much lower than the rest. And it is that lower payment that then makes this product so much more affordable for those people who would fail the affordability checks with the eligible income they have available in the standard RIO, TIO, or as I say, with some of the other hybrid products in the market. And then it brings you to my 4th and favourite one of these in terms of the one I'm most passionate about. And it's for those customers that are stuck in that 5-year fixed rate, rinse, repeat trap and or the interest only trap. Whereas a borrower at the end of that 5-year fixed rate period or at the end of their interest only period or both would find themselves in a position where they're just going to have to do another 5-year fixed rate, extend their interest only, roll the dice and see what the world looks like at that point in the future. And that isn't any actual good exit strategy to a borrower who might say they will downsize if they have to, but really doesn't want to. Now, this product does give people a credible exit strategy for that trap if they find themselves stuck in it. Now, getting into the technical then, this is what we call a minimal viable product currently in a pilot. And as such, it's limited on its age expectation of, we say there on screen, between 55 and 62. So as young as 55 and mature as 62 on application entry. Now, we have actually recently increased that slightly for some 63-year-olds that may actually be eligible for this product as well. And I'll talk a little bit about that and what impacts that a little bit later in the presentation. Now, the contractual payment term itself is determined by the eldest borrower's age on entry, because it'll be their 66th birthday when that term will end. So to put that into simple terms, this is for somebody at age 55 will have a circa 11-year term, or 60-year-old a circa 6-year term, just to bring that a little bit more to life. And what does that extra commitment to making that mortgage payment get you? Well, we've got demonstrations across all 4 of the customer personas in case studies and visuals for you to look at. But in terms of Flexi versus Flexi PTLM, you're looking at about an extra 8% more of their home's value being released on a tax-free basis. So customer persona number 1. And again, as I say, I've actually increased recently from 62 to allow some 63-year-olds to proceed. Now, there is a rule that's built into all lifetime mortgages that if you are going to have a payment that's required to be made and it is in excess of the interest-only equivalent servicing the entire debt, it will therefore no longer be able to qualify as a lifetime mortgage. So what you will find with this product is that not all products will be available at all ages, but at 63, we can at least see whether or not a payment term lifetime mortgage would be available to them. But looking at this, as I say, it's most useful to the ages up to 62. And you can see here a blue line, which shows you the high releases in the market as it stands, versus the green line, which is what you can achieve using a payment term lifetime mortgage. So again, just to bring that a little bit more to life, you can see here we've got the beautiful Stephanie, age 55, that can release just over £64,000 at a rate of 6.94 on standard Flexi terms, versus she does have money to contribute towards her mortgage, and for a payment of £264 a month for a term of around 11 years, she would be able to release an extra £22,000. And again, because this product travels with less risk for the funder, because that partially serviced interest is controlling the roll-up, which is ultimately what enables us to release the extra amount of borrowing, she's actually even getting a better rate for that. So it's definitely one to be considered. Now, coming to customer persona number 2, there is here, we haven't given this gentleman a name, so we'll call him Bob. Our lovely Bob has a property worth £285,000 and wants to release £77,805 and can do in the lifetime market with a rate of 8.6. Now, he can sit back, not make a payment if he does not want to, and enjoy the home for the rest of his life or until he can. But that is going to have an impact on his estate of just over £281,000 in 15 years' time. Now, we'll pause here just to slightly digress in terms of some of the other conversations we have had and will be having during the Learning Lab Live, in terms of, the positivity that comes from actually making contributions to your mortgage, even if you don't have to. And across the More to Life panel of funders, as I call them, there is a facility to do that on the initial borrowing amount on at least a monthly basis on the annual return of up to 10% on most products, it's 10% here, up to 12% on our Maxi product. Now, you will see here that Bob had £244 to pay, and there you can see by doing that, even on this high release plan on a voluntary basis, it has a really positive impact on his total cost of borrowing. And it's also worth to pause there and just say to people who would say to me at this point, but my customer isn't concerned about their estate or leaving the maximum they can to their children or grandchildren, that's absolutely fine. But what I would say, there is still a customer benefit to them doing that, because if they manage the roll-up of interest or mitigate it altogether if they can, what they are doing is protecting the equity in their asset should they have future borrowing needs. So again, when we talk about consumer duty, I'm thinking about that foreseeable harm. Even if they don't want to and they're not worried about their estate, it still has a potential benefit for them if they do. But that aside, our beautiful Bob here actually is happy to pay the £244 per month and can do for a period of 8 years. And that will attract a rate of 6.46%. And that's a saving of 2.14. That's a massive saving. And you can see there in front of you the positive impact that that does have on his estate. Now, customer personas number 4, those people who would fail a standard RIO, TO, or alternative hybrid products where they require you to service the entire debt. And as I say, it's quite simple these days. You've got an amount of income coming in, you've got an amount of expenditure going out, and what you are left with is a net disposable income. And because our payment is so much lower than the other alternatives in the market, it has just got more of a chance of sitting within that net disposable income budget. And this is where I say, I also think I've got another customer persona here where it's demonstrated quite beautifully on the next slide that we're looking at, where, you know, they could maybe perhaps afford a standard interest only mortgage. This is one that we're looking at taking to age 70 for a 55-year-old, the beautiful Julie Walton here, 70 being the new age 65 in terms of retirement these days. And it's going to cost her £431. Now, in this scenario, she actually does not want the cliff edge, which is going to be in 15 years' time. She needs to find a way of repaying that debt. Now, again, we all say we could downsize, which we could, but nobody really wants to. So alternatively, then she turns to a RIO, which is going to cost a little bit more. That's £572, but it's not going to create that cliff edge. But it does travel with having to make a contractual payment term for the rest of her life, let's face it. So anticipated to age 87. However, Flexi PTLM, with its unique hybrid approach of part lifetime, part term mortgage, will find that she can pay that £284, which is just lower than the other alternatives, therefore more likely to pass the affordability tests. And she will have her term end on that contractual basis in 10 years and 6 months. Now, I will cover our core 4 features in a little bit more detail in a second, but I'm going to call out one of them in particular now, which is actually one of the superpowers of this product. Is not only can you need to make your contractual payments, but you have the voluntary option of making overpayments. As I say, initial borrowing, 10% of that every year, up to 12 times in the year, and use that in a really positive way. Because what we actually do is we use that overpayment to pay off the contractual interest servicing that's required sooner, and therefore we reduce the term. So this is musing that Julie did have the option of going down the interest only route, but she did not want the cliff edge of having to repay at age 70. She considered the retirement interest only, but didn't want to have that payment sword of Damocles hanging over her head for the rest of her life. So has opted alternatively for the payment term lifetime mortgage, but she is paying the £431 because she could afford it and is happy to do so. And by making that overpayment on a voluntary basis, she has now reduced her term to 6 years and 5 months. So again, a really great way in which we can use this product to get people to the point of being safe and happy in their home for the rest of their lives with a payment term. Now, talking about those features, then we will just look again, as I say, up to 10% of the initial loan on an annual basis can be made redemption charge free. And as I say, that's 12 times in a year with a minimum payment of £50. And that can be set up on a standing order to make it really easy for the customer to manage. We do have fixed ERCs on this plan. It starts at 10% year 1, reducing 1% until year 10, when you've just got a 5-year tail at 1%. But worth noting that any charge that you do pay is on the balance outstanding. So as they have, if they have used that overpayment facility to control or even reduce their debt, the charge that's applicable is going to be on their balance. So that's again a great mitigant to a known foreseeable harm if they do need to redeem in the future. And then we have our 2 early repayment charge fee-free events, which the first of called our compassionate clause. So that's where a period of 3 years after one of the joint parties passed away or moved into long-term care, they can actually redeem that plan fee-free because they find that plan no longer suits their circumstances. And finally, our downsizing protection. So that's after a 5-year period of the plan being in place, a customer goes to port their mortgage and finds they can't because the property they want to move to doesn't meet the criteria for the funder at that time. Again, they can redeem ERC free. And interestingly, that can also apply to you going abroad because we do not lend abroad. So moving on to some of the more technical. Now with Flexi payment term, the actual property criteria is exactly the same as what you already know and love. So some of those great features such as proximity to commercial, where as long as it doesn't show a party wall a floor or a ceiling, we can consider, subject to valuer's comments, up to 4 shared septic tanks, complex lease scenarios of up to 4 flats in a block, not the standard 2 available from other funders. That is all still there. But one thing I will shout out that is different with Flexi PTLM as opposed to Flexi Choices, there is an application fee of £999, but that can be added above the maximum loan to value, so it won't impede their borrowing objectives. Now, when it comes to sourcing, what I would say to you is that it needs to be sourced via the standard sourcing, not the quick quote. Quick quote will only work for you if you're using a single life scenario, because the term is determined by the eldest borrower's age. At age 66 ending, you need to put the date of birth in, or you will not get the correct information back from the system. When you are in the system, though, you will see that you've got a number of options, and we need to shout these out, otherwise you will not see this product. So I always look for the max release in the first instance, that you can toggle that on, and I don't worry too much about age and expertise because it doesn't impact this particular product. You then have these boxes as you scroll down and work through the input screen for getting your sourcing options open. And you will see here you've got a box that says lifetime mandatory payments. You've got a budget box as well where you need to put in a sum of money. And you've also got a toggle on there called maximum affordability. So what you need to do here is to be able to tick the box that says you want to see these mandatory payments, or you simply won't. And equally, it's a question for yourselves to determine why. You can put a budget in here. However, if you put a specific budget in, you won't see any near misses. So somebody who entered a budget, say, of £300, which was a real case study for me recently, actually could find a PTLM, which was the absolute best option compared to everything else for them, but the monthly payment was £303. So by putting £300 in, they don't see those near misses. So some people are choosing to put a big, silly number in that box so they can see all of the options for their customer and then ski downhill when it comes to what they can actually afford. And I actually do recommend you take off the maximize then affordability toggle, because that £10,000, if you leave that on, will actually play into your total cost of borrowing and therefore spoil your sourcing results. And when you're in sourcing, you will see there are all of the different available options to you in terms of what's available on the Flexi and More to Life plans. And you will see here that you've shown just 2 of what are actually 3 product variants. And again, that comes back to what I said earlier with regards to the payment term options not being available at all ages. If that interest only rule is breached, then you won't see those additional products. Now, when you're actually in sourcing, you need to access your filters as well, where you can refine. So this is where I'm showing you here. We've actually put on, now we've seen all of the options. We've put on an £800 budget, and also looking at maybe the customer might want to reduce the term or be specific about how long they want to make that repayment for. This was a 60-year-old that only wanted to make payments up until they retired at 67, hence the 7-year term. Now, I also switched on the maximize affordability toggle whilst I was on the filters there, or I will do in a second. But here you can see as you hover over that this now gives you an anticipated term of 5 years and 11 months with a £603 monthly payment. Now back into those filters, switch on that maximize affordability toggle, and this is where you see the power of the overpayment with PTLM, where you can see the fact that they're now making £603 as a contractual payment, but 197 as a voluntary payment, which has now shorted their contractual payment term down to 4 years and 3 months, and again positively impacted the total cost of borrowing. Now, there is the eligibility criteria that we talked about there. We've talked about the ages and where that sits, that they do need to be permanent UK residents with indefinite leave to remain with a 3-year history of being so. Now, there does need to be an eligible income, which is either earned with an employment that's for a minimum of 6 months or self-employed with 2 years trading. We can accept some investment income up to 50% of it, but there has to be a maximum of 10% of the overall borrowing income available. Now, we can lend into retirement and into retirement. So if somebody is currently in retirement, then we absolutely can support, and we can take pension income as an additional income, if not a sole income. But equally, if a 55-year-old says to us at age 60 they're going to retire, then we can proceed with those customers as well. And we just need to underwrite both incomes to make sure that the term, the payment remains affordable throughout. And we do have a first stress test, but I know that's often the challenge in the Rio market, where they say those plans fall down from an affordability point of view. But we have a number of mitigants within More to Life to go overcome that hurdle, even as much as taking out a new small life insurance policy for just the contractual payment term. And if we go back to the Stephanie example, if that were a joint plan, that would just be for the £22,000 additional borrowing she was able to release in excess of standard flexi terms. Now, that's the ability to pay covered off, but we also need to see that the customer has a willingness to pay. So we're not looking for any CCJs within the last 6 years or defaults in the last 3. We can ignore some small utility and communications defaults, and we're not looking for any payday loans in the last 2. Now, what I would say, though, this is a pilot, and similar to, I would say, some of the income types we say that we can't accept, try us. If it sounds like it's a good blend in your mind, give us a ring. It's somebody from an income point of view. I said eligible income, it had to be earned, so that would exclude benefit income, for example. But if you did have something like a PIP payment that was awarded for life, I'd like to have a look at that and challenge what we can do with that in terms of maybe doing a funder referral that will help us through pilot shape what the full product of this will be once it's out of its pilot and beyond its MVP status. And that's the same with this adverse credit. I would say again, we have a worse status 2, and that can be across multiple credit lines, including secured credit. But we say we'd like it to be 0 at application. But again, if there's something there that we can work with, we absolutely will. And you'll see there no history of bankruptcy, repossession, IVAs, or unacceptable. But it does also say active DMPs. Now, again, I had a recent one that we did look to refer because it had a perfect credit record for the last 6 years. Their DMP was older than that. They'd not missed a payment on that DMP, and they were paying it off as part of the transaction. It unfortunately didn't go ahead for other reasons, but if it had, we definitely would have referred that one to the funder to see if we could lend. Now, nearly to the end of this, but it's a nice place for me just to let you know that this is Flexi, and it does travel with that beautiful rate guarantee. So as long as you lock in a postcode when you create your KFI, that rate is guaranteed for 21 days. You have otherwise the standard validity periods that you see on screen there, which can be extended up to 90 days from offer to completion on purchases, should we be able to complete within that time scale. Now, also, because it is Flexi, it's just a quick reminder that we do need an upload of the suitability report into the repository, which you guys should be used to doing anyway, as that is a feature of Flexi as standard. So all that's left to say is to say thank you for your time today. I hope you found that presentation useful. And as I say, keep an eye out in your inbox for additional invites to future Learning Lab Lives that are available to you throughout the summer and beyond. Enjoy the rest of your day.